Hello friend, welcome to yet another video in our series Finance and Investing Tidbits. The theme of this video is expanding capital rather than monthly return is far more important. Now this may sound a little unusual to you because that may go against the conventional wisdom. Quite often as people approach their retirement, they are always focused on getting some money in their bank account every month. So the whole pension scheme, many other schemes which give you interest every month into your account or monthly dividend schemes of mutual funds all have thrived on this idea that people need to have some money in their account every month. Quite often this is absolutely tax ineffective because these amounts that come to your bank account, you are required to pay taxes on them first and then use it for the monthly expenses for which you have actually sought this kind of a monthly account or monthly interest in your bank account. Now, this goal somehow has been embedded in people's minds since the time the rate of interest was very high. So in the 90s, people used to earn happily 12%, 15% interest, 80. In the 80s also the same scenario was quite visible. So somehow people's calculation was that, when I retire, I get a certain lump sum and 12% per year or 1% per month is something that I can easily budget. And if I'm able to meet my monthly expenses out of that 1% interest, I am done. And if I'm able to save something, then I'll reinvest it. That was the typical logic on which people worked, right? And that somehow has remained embedded in people's mind even now. The paradigm has changed a lot since then. People retire early nowadays, they live longer, and interest rates have fallen. This makes it tough to manage finances. And then when you get that money by way of interest into your account, quite often people who have retired early realize that, that's not sufficient to meet their expenses. Luckily, we still have the family bonds in our Indian society, and therefore the next generation supports them. And that way they are taken care of. But otherwise, if somebody wants to be kind of self-sufficient or independent in one's finances, then clearly this ideology of receiving money into one's bank account and meeting the expenses is not going to be useful. So irrespective of whatever is the rate of interest or return, the principle remains the same, and the principle is that we should let our capital grow continuously and take the money out only to the extent we need it. Otherwise, what happens is through various schemes that we actually subscribe to, we keep on getting some interest, some dividend throughout the month, and whether we need it or not, the money keeps on coming in there. It remains idle there. It fetches 3.5% or 4% interest, and it saturates there, right? Instead, what we should do is we should sell the units whenever there is a need, or we can sell shares to meet our needs rather than getting some amount into the bank account every month and allowing it to remain idle. The other shares, the other units of mutual funds will continue to compound anyway. And of course, I have talked about, in variety of my videos, how we should study 5 important markets like the money market, the bond market, the share market, the oil market, and the gold market. So there are these 5 charts that I have captured in one of my videos. Do explore that. It's just a 10-minute video and you can easily master that. So by aligning our investments and the units or mutual funds that we buy in appropriate asset classes, we can let our capital grow rather than taking the money out. So that's the reason why I always recommend to people that when it comes to mutual fund schemes, never invest in dividend schemes. Always invest in growth schemes because that's where your capital is going to grow. If you need the money, redeem the units. And again, your tax incidence by redeeming those units is going to be very minimal. And that's the way we need to allow our capital to grow. Do also see my videos on the power of compounding and how to create a portfolio with just 2 schemes of mutual fund. We should not let our money remain idle or earn a much lower return than what it deserves to earn. You worked hard but your money should also work hard. And I'm going to share the link or links to some of these videos. Do explore them. So let us all ensure that we expand our capital through compounding and not just be happy earning some interest every month and not allow our capital to grow. That's going to be not very fair to our own hard-earned money. Thank you for watching this video and do share it if you like it. Thank you.